Hello, everyone. On this module, we're going to be talking a little bit about investment schools. The goal here is to give you a little bit of context before we go deeper into modern portfolio theory, basically. So we're going to try to put a little bit of context on different approaches to investments that have been used over the years. So we have basically here three that we are going to be talking about approaches to investments. Okay, we have the fundamental analysis or fundamentalists, technical analysis, and also the efficient market risk return approach to investments as well. I mean, there are others, but we're going to try to narrow down to those three, highlight some differences between them to give you a little bit of context before we move forward. So the fundamental analysis basically focus on the company's economic factors to determine its value or intrinsic value. So basically, they are looking at uh, analysis of financial measures, industry setting, management, focusing on long-term gains. So what they're basically doing, they're trying to look at the economic fundamentals that will affect the future cash flows or the discount rate of stocks or equities or securities there. Okay, so if they think that management is good, for instance, that they have chances of having higher cash flows in the future, that's what they will try to look at, and they will assume that the stock price will converge eventually to its intrinsic value. For instance, there are people that try to model or forecast companies' cash flow, future cash flows, and compare that to the actual price of the market. And sometimes they think that the company has still value on that. However, the market, for some reason, it's not reflecting that yet. So meaning that they can buy the company because it has intrinsic value on the expectation that eventually this value will realize itself and the market price will adjust itself as well. Okay. So try to think on fundamental economic factors that will affect company's future cash flows or try to figure out the value of the company. A very good example of that would be Warren Buffett, right? Famous for many, many quotes. We just have one here. Price is what you pay and value is what you get. So basically, he was very much looking at fundamental factors, management. If he believed in the management of a company, he would buy it, right? And there are some, he actually had a very good return over the years. So we have here a dollar invested with him in 1964 will be worth it today $27,000. While if you would just index it that on S&P 500, it would be $200. Okay, so he was very successful on that. In fact, he's still, I think, one of the executives of Berkshire Hathaway. So this is one of the philosophies to approach investments. The second one, technical analysis, basically they focus on securities prices patterns and correlations to predict future movements. So they don't really care about like fundamental if management is good or bad. They're gonna look at like past price charts, trade volumes, and try to forecast based on patterns that they see on these charts future prices. Okay, so usually they focus more on short-term trades, so they ignore this value of this stock and instead consider this trend and patterns created by investors emotional responses many times to price movements. Okay, so if I don't know some news come out and everyone now is kind of worried about this company and drives price down, you might actually say, okay, this will eventually go up based on last year's similar responses of this price, something like that. Okay, And this is often mixed with quantitative methods, algorithms that they put there to try to match or see this correlation between prices, volumes, sometimes other things. But this is different than the fundamental approach to investments. A good example of that would be Jim Simons. I don't know if you guys have read the book The Man Who Solved the Market, which is the this story of him. And he funded Medallion, a fund, okay, which is actually closed to outside investors. But from 1988 to 2018, he had a gross return of 66% a year. So that's huge returns. He did charge a very high management fee for that, but even though after that, he would still yield almost 40% a year average net return on that period. So he was very successful in that. Okay, but there are other also counter evidence on both approaches. Okay, that presents, so like we have evidence in favor, evidence against it. I'm not gonna discuss it, but those are main. Those are two approaches to investments. Okay, and one thing about them is that both are somehow a form of active management. Okay, so they don't believe in the efficient market hypothesis, meaning that they think that they can beat the market. Okay, so there are a lot of studies showing that sometimes they don't. Sometimes we have some example also showing that they can, uh, but they neglect this efficient market hypothesis, saying that the prices that we see on the market not really represent all the information that there is available, and we can find stocks that are undervalued in the market, or that we can predict prices in the market better than others. So they don't believe in that, and they try to actively beat the market. Now, the the third approach that we are going to mainly focus on is the efficient market hypothesis approach to investments. Okay, so basically, if you believe that, if you believe that markets are efficient, you don't believe that you can beat it. Okay, so basically, there is part of risk that it can be like diversifiable risk or firm specific risk that you can diversify in a portfolio by having certain number of assets and considering the correlation between them. And there are also non-diversifiable risk or systematic risks, which is what investors should be rewarded for. So basically, if your portfolio is more is riskier comparing to the market, you should be rewarded. You should be more. You should get better returns for that. Okay, we're gonna be talking more about it. So basically, individuals should, instead of trying to beat the market, invest in index funds that track performance of broad asset categories, matching with each one's risk preferences. Okay, so basically a form of passive management. Very good example of that, John Bogle, founder of the Vanguard Group, that has this famous quote here that illustrate the point of this approach. Okay, so don't look for the needle in the haystack. Instead, just buy the haystack or just buy an index fund that you should be fine, and that you will be rewarded by the amount of risk that your portfolio carries comparing to the market. Okay. So we're going to be focusing mainly on this approach to investments. And finally, there are also evidence on this third theory that it yields good returns. This is from 2007. You can see here the indexes beat stock pickers over 15 years. Okay, so there's also evidence that it works. There are also criticisms against it, and this is what we are going to be focused on going forward.